Hello, hello, everybody. We are live. Hopefully we're live. Let me know when you get here and let me know if we're live. I am coming at you on YouTube, my YouTube channel, Jamie Trull. Make sure to like this video and subscribe to the channel. Also, if you are watching this in my Financial Literacy for Women Business Owners group, hello to you, friends. And this is also being broadcast on my business page. So we are all over the place. This is our normal Wednesdays time slot. It's 10 a.m. Central Time on Wednesday, which is where I show up and we talk about different topics that you guys are asking about. And so right now, all of our stimulus content I am doing in the Friday live. So Friday at 1:30 p.m. Central Time. But these typically on Wednesday, we have a variety of different financial literacy topics. And so this one is a little bit different than what we normally do, right? So this one, we're going to be talking a little bit more on the personal finance side. You guys know that oftentimes I'm focused on the business side of things, but as business owners, as entrepreneurs, personal and business are very, very, very closely tied together. So it's really important also that we're looking at how to be financially literate from the personal side of things. Also, I don't know who knows this, but April, I'm pretty excited about this. April is Financial Literacy Month. So y'all maybe didn't know that there was a Financial Literacy Month, but it is April. And obviously this is a topic that I am really, really passionate about. I know this is a topic that my guest today, Laurie, is really, really passionate about too. And she really wanted to come here. And I was so excited to have her come talk about investing. So we're talking about all things investing, or what we can in a short amount of time, not all things investing, but we're going to talk about, things like how to get started with investing, right? What are good tactics? How do you kind of get started in this world if it's not something you're familiar with or really know what to do with, right? We're going to talk about things like compound interest and risk and all of those decisions we need to make around where we put our money so that our money is working for us, right? Of course, we know we work for our money, but we want to be able to put our money at work for us, right, Laurie?
Absolutely.
Yes, that's the goal, right? So we work for it, and then it works for us. That's the dream. And I love this. Make sure you guys, when you are watching, especially if you're watching in the Facebook group, there should be something asking permission from StreamYard to see your name. So make sure to hit that. That way I can see your lovely names, like Myrnie here. Okay, so I'll give you a quick intro and then I'm going to turn it over to Laurie. So Laurie is one of our preferred vendors in the group. And she is fantastic. She knows all the things, personal finance, creating a plan for your future, for retirement, all of those things. So Laurie, tell people a little bit about what you do and who you are.
Well, thank you. I'm so happy to be here, Jamie. Hi, everybody. I'm Laurie Bodisch, and I started my company, Her Wealth Coach, about 2 years ago after spending a little over 30 years in the investing world in corporate finance. So too many times I saw women struggle with investing, and usually by the time that I was able to help them out, with being an investment portfolio manager, it was at a point where their husband had passed away and they had no clue what to do, or they were going through a divorce, or they inherited this huge sum of money, but had no idea what to do with it. So my mission and my goal with Her Wealth Coach is to help educate women on the basics of personal finance, which of course investing is a big part of that. And my life's been pretty much dedicated to it. So I'm so excited to have the opportunity to be here and chat about it with you.
Yeah, we were so excited to have you, especially for Financial Literacy Month. I thought this was the perfect way to kind of kick us off. So Laurie, let me get this right. You're a CFTA.
Yes.
Tell us what that is.
What is that? And okay, let's start with the acronyms and jargon of financial.
Yes, right? Like we're just going to start right off. But what does that mean in kind of, normal person terms?
Normal person terms. What that means, it stands for I'm a certified trust and financial advisor. Okay. That what I do is I help people put together trusts in order to assets and avoid probate after the passing of an individual or spouse. So a lot of my background in banking was managing the trust portfolios at the bank.
Gotcha. Oh, that's cool. I think it's really interesting too that you bring up that a lot of times that and it does disproportionately happen to women. Now, in my case, it would have been until at least recently, it would have been the opposite of if something ever happened to me, my husband would be like, I don't know where anything is. Like, I don't have any idea how much money we have or where to find it. Like, he would be that person. Now we've kind of sorted that out. We have more of a plan. But I think a lot of times that's reversed, right? Like where, a lot of that is sort of controlled by, the husband if you're married. And so it isn't until men die first, you guys, almost always, most of the time.
That's a
And
big part of
so
it.
there are so many people I know that have gone through that, which they're like, okay, what do I do now? Right? What do I do now? I don't even know how much, do I need to go back to work? Like, what do I need to do to make sure that I'm set up well? So I think that's a really important point that we want to get ahead of this, right? We want to get ahead of this and be empowered in our knowledge in and of ourselves to yes, of course, prepare for the worst, but also just have that knowledge for us and have that confidence and knowing that we're doing the right things, right? And so I think it is so, so important what we do. So for somebody who has never invested before, right? Maybe they're like, I don't know, the stock market feels a little bit casino-y. I don't want to risk, it's scary, right? Risk
It is.
your money in something we know, okay, if I put it in a bank account, I'm probably not going to make a whole heck of a lot of interest, but it's not going to disappear, right? So it feels like you're like, okay, it's fine. I'll just save it in a normal bank account, maybe a money market, right? So tell us a little bit about your thoughts on that for somebody who's like, that sounds really risky. I don't know if I want to do that. What advice would you give somebody who feels like that?
Oh, certainly. And that's one of the biggest myths that I like to try to bust when it comes to investing, because let's be honest, most times we don't learn about it in school, but yet we're expected just to know you're supposed to do this. So, okay, well, how do I do it? Give me that class in high school rather than having to dissect a frog or something that
I could go on a whole rant about that. That was one of my first business ideas. And this was 15 years ago, was finance for life. I wanted to go teach finance for life classes to high school and college students that are like, here's what a mortgage is. Here's what a credit card is. Here's what credit is. Here's what investing is, right? Because nobody teaches us this stuff. It's just we're going to give you all this information. Most of it's kind of useless and you won't ever use it, and send you out into the world. And then you got to figure out the rest, right?
Yes. And, thank goodness for a lot of what's happened technology wise, because think about it, 10 or 15 years ago, you and I wouldn't be sitting here even having a discussion about it. So now there's so many resources that are available for us to get started with investing. But then you start to go down the rabbit hole of what I call Dr. Google, and well, how do I do this and how do I do that? And then you get overwhelmed. And when we get overwhelmed, what happens? Usually paralysis analysis sets in and we do nothing. So being here and learning just the basics is that you can do this too online. You can do it yourself. A little bit of education goes a really long way. And we fear the unknown. And until we make a commitment and are dedicated to wanting to make a change in life and for ourselves and our family, that's the big deal. And I know you're huge on mindset. Mm-hmm. And mindset, we develop those thoughts and habits really early in life. And if you start to think about, things you experienced when you were younger, a lot of times it was your dad took care of the finances, or numbers are something that men are better at, et cetera, et cetera. When it comes down to, 80% of the time, women who go with their heart and really have learned a little bit about investing make better investors because of the aspect of caring and wanting to know more. So to get started, the first thing I would say is just to participate in groups that talk about money, that you start to excuse me, that you start to understand some of the basic terms. I mean, that would probably be the best way to start. Like learn, what credit is, learn about what a stock is, what a bond is. And, let's talk about the fact that, you don't have to make a decision on one stock that's going to be life changing. There's so many different vehicles and avenues of products, or what we call vehicles that you can invest in, where you diversify, another word in investing, that you want to make sure when you're starting out your portfolio, you're not putting all of your eggs in one basket. There's products that you can, what we call a mutual fund or an index fund, or even an exchange traded fund. Those are three probably key phrases and jargon terms that you want to familiarize yourself, because those three investments right there automatically give you diversification for a beginner.
Yeah, I think diversification is one of those things where like we hear the word, we're like, okay, I know that means like I have to have different things and not to put all my eggs in one basket. But I also think there's something like sometimes we get drawn into the allure of like, oh man, if I had just put all of my money into Apple stock in 1985, I would have my own island right now, right? And you're just like, oh, how do I find the next big thing?
Right.
And really, like, of course, what my husband and I do, we have most of our money is in kind of diverse things anyway, right? So we can talk about kind of, what those vehicles are, like mutual funds, exchange traded funds, if we want to get into any of that. But a lot of it isn't in those types of things. We also have like bonds and a lot of things that are diversified. And then we have a little bit of play money that we're like, okay, let's just see if we can pick the next big one, but not anything that, not like a amount of money that if we lost it, it would be like, we got to go sell our house now. Right. But I think that that's something that we get this allure of, like, now everybody's talking about Bitcoin, and I don't want to miss Bitcoin being the next big thing. And we're not going to get into all of that.
The whole FOMO, the fear of missing out on the next
like, oh, if I
big
had just, just been a part of that. And I think that's one of the things that we have to just be like, what are our goals, right? What are the long-term goals that we have? And I know that's where you usually start, Laurie, which is like, well, we can't make a plan because people are, what should I do with my money? Well, that depends. What do you want to do, right? Like, what are some of the key things people need to think about when they're going into making a plan for investing and for their money? What would you say are like the key things to really be considering?
Goals are the first and foremost.
Yeah.
What you'll want, because you have to identify, you as a human being have a goal. You've got to have something that you're dreaming about, or something that is coming up in the future, a wedding, certain individual events you have to plan for, but then those are more short term. But then there's the longer term goals. Think about what you want your lifestyle to be like in 5 years, in 10 years, in 30 years. Once you know where you're going, you can start and make a path to get there. And what I find so often is that when you're not educated on, when we talk about risk, sometimes people take way too much risk to get to their goals, and it's unnecessary risk. So, kind of balancing that is oh so important when you're talking about your goals and achieving financial freedom and independence.
Yeah, sorry, I'm on mute because there's a child situation happening. which is the usual around here. But yes, I agree. It is, you have to kind of dial back to what are your goals? What are the things that you want to be achieving? And we don't often always put thought into that. Like, when do you want to retire? Right? Like, ideally, when do you want to retire? I mean, we probably would all say like, well, as soon as possible, but when do you want to retire? How much money do you want to have each year when you retire? Do you want to pay for your kids' college? Do you like, what are the various different things that you want to be doing? And then you make the plan backwards, right? And that's something that I'm actually not great at. I've just always been the whole, like, I'm just going to save as much as I can. I don't know what I'm going to do with it, but I'm just going to save it. And that's kind of my MO, and has been. And Laurie and I have talked about this because Laurie's helping me with a financial plan for my personal life to kind of figure out, what do we need? What do we have? What are the things that we can actually do with our money, and put more of a picture to it, right? Versus just, let's just like, just in case, let's just keep as much as we can, versus like, oh no, we can think about how we can use that to both create the life that we want, to be more comfortable in the amounts that we can give as well. Like, so there's just a lot wrapped up in it, that you have to know what your overall goals are and what really motivates you first. So let's talk about what would you suggest someone invest in if they've never had an investment? What's the first thing they buy?
What I would suggest they do is that they buy some sort of an exchange traded fund or mutual fund that's invested in what we call the broad market. Not anything in particular, but an overall, say, stock portfolio that has a portion in that, and also has a portion in bonds, because you always want to think about, well, let me backtrack for a minute. There's three major what we call asset classes or investment types. There's cash or money market type instruments. Those are things that are very liquid and we can get to at a moment's notice. A lot of times, call it part of our emergency fund. The second part of our investments are generally stock investments, or what are also called equities, and that represents ownership in a company. And the third type of investment is a bond, which is you'll generally invest in that. They're generally considered safer, and they kick off what's called an interest payment. So many times people will invest a portion in cash so that they always have the emergency money there. They will invest a portion in bonds so that they know, if the market starts doing one of these things, generally, again, all of this is generally, we've seen crazier times in the economy. That'll be a safer investment. And then a portion in stocks. And you can buy all of that in a mutual fund. I mean, you can get one fund that'll give you all of that if you're just beginning, and it'll give you exposure into the market.
Yes, absolutely. And I think too, one of the things, and this was something that was interesting to me when I was younger. So like, and let's talk about, how does age also play a part in your decision-making on what you invest in, right? And I think to the extent that the thought process being, when you're investing, this is excess cash that you don't necessarily need to live on, right? So, when you're making those determinations about where to put your money, what would you say to someone who's 25 versus maybe 55?
Definitely. That plays a huge part in determining where you're going to invest. If you're 25, you are certainly going to want to invest more in stocks than you do in bonds, because you have plenty of time to experience ups and downs in the stock market. You also have time you could be also adding to those investments over time. So the more stocks are considered growth, the more growth you have when you're younger, the better off you're going to be as time goes on. Because again, usually over a 10-year period, stocks will continue to go on an upward trajectory. Now, if you're at age 55, I'm not far from there. You still want to have money in both, but you're going to want to probably start to put more money onto the bond side into more conservative type investments because you are getting closer to what we call in the US traditional retirement age. Um, and again, that's a whole nother conversation on when do you want to retire. So all of it goes back to all of these little pieces that need to go into place to get it started. But traditionally, that's you'll have more exposure to stocks when you're younger and gradually pull that back as you approach retirement age.
Right. So it's kind of that risk reward, right? Where when you're younger, you probably have more risk tolerance. It may not feel like it, right? Because you don't have as much money in general, probably when you're younger, but you have more risk tolerance in that. Let's say, so 2008 happens, right? What was that? That was 13 years ago now. Holy moly. So like I'm in my mid 20s. And I just remember, and I started an investment account when I was 17. I've always, my dad, that's what he does. So my background is in like basically company valuation. So it's something that's been comfortable for me. But when 2008 happened, we had a huge flash crash. I mean, literally, my money, which to me felt like a lot, I lost half of it almost in a week, right? And I'm just sitting there like, oh, what is happening? Because at that point, it all just been like hunky dory, everything just goes up, right? And so for me, it was terrifying. But for like people like my parents or anybody that had more money invested, or more money invested later in life, right? Now you're in a situation where you're like, shoot, I was planning to retire next year and I can't, right? And so if you're in that situation where you're highly, highly in more volatile type things, there can be a way bigger reward over the long term. And I think that's important to say, right? Over the long term, to be thinking long term like that, but the short term can be crazy. And we've seen that time and time again, right? The short term, you almost got to have a strong stomach.
If you just look at the last year, I mean, when word of COVID came out and, shutdowns, et cetera, the market tanked. And it was the people who probably have had more experience and have been through 2008, 2009 before that are kind of like the firefighters who run into a burning building, the people who can stomach getting in and putting money in at those times when everybody else is selling and getting out, usually, make out best over time. But history shows us that, you can't time the market. You just can't do it. You can't be jumping in, out, and everything else, which brings up the thought of if you do get into investing, I would highly suggest that you do what's called a dollar cost averaging sort of plan, which basically means that, you take $100 or $500, whatever you have set aside to start investing, have that automatically invested each month so that you're buying at various prices. You're not influenced by your emotions or what's happening in this world around us at that moment in time. And that's usually the way that it makes sense. And if you can't stomach the risk, I mean, I remember my dad, bless his heart, every day would check to see how the market closed and what his investments were doing. Whereas my mom was more of, I don't want to see it. I just know that over time it'll be better. So again, you have to take into consideration what your tolerance is for risk, and being more educated, I think gives you, I know gives you more of a tolerance for risk when you understand something.
And I think your point too I think this is something we all fall into the trap of, including myself, which is like feeling like somehow I'm going to be able to time the market. And what happens then, right? When you're just waiting for a drop, you're waiting for it to go lower, almost always over the grand scheme of time, it's better to just, as Laurie said, a little bit at a time. You're investing at different levels when you do that. Some are going to be high, some are going to be low. But remember, over time, the market generally is going to go up. Not individual stocks necessarily, but the market as a whole. And so that's something important to consider, is that you don't want to necessarily get caught up in this, like, I'm going to buy at the low, right? And I do think it's interesting, because the reason the market crashes, let's talk about that, right? It's because everybody panics and sells, because they're like, oh no, everything's going down, right? That's when you don't sell, when you're like, but now, I mean, there's probably a time where maybe you're like, oh, this is going to get worse before it gets better, maybe. But when it's because everybody panics on the way down, and then what other people start buying, and then it goes back up, and then those people are like, oh shoot,
what did I do? Why did I do that?
I can't tell you how many times, like, you just make this gut reaction. So it is I think better to have a formula. Like, I just put this much money in, every so often. Unless you have a strong stomach, don't reassess every single day, because you are going to make decisions based on emotion versus like your plan, right? It's always, and that is something that I always have to write down. Here's my plan. When it gets to this, like, if I want to buy and sell, which a lot of times I don't, I just hold things mostly for the long term, but I have a plan that I go by. It's not based on emotion, because you do not make good decisions based on emotion most of the time, right? That's just true in life. I feel like
Absolutely.
Definitely true when it comes to money and investing as well.
Money is so personal, and being prepared, knowing you have a plan in place, and you know that, yes, I knew this was going to happen, because the market's going to go down again. It happens. Yeah. I knew this was going to happen. Stay the course. And, you can probably make some adjustments, but overall, do not sell everything at once.
And so Autumn is saying, so she started investing in mutual funds, and then the pandemic hit, which might make you think, oh, I got to pull everything out. But the truth is, we have more than recovered from where we were. So if we're just like, okay, I'm going to back away, and then I'm going to buy, like, as we're on the way down, I'm going to be buying. And as we're coming back up, I'm buying. You're even better off, right? Because now you have been able to get the value of that dip as well, versus just being like, I'm stepping away for a while, right? And this is something, again, like, I say all of this, and I need to say it to myself, because I definitely violate general rules of investing all the time. But I think that you're never going to be able to time it exactly. I mean, every once in a while you'll get lucky, but if you will miss out on a lot of the boat when you wait sometimes, right? Like, when you're just like, I'm going to wait, it just becomes this perpetual waiting that you're doing. Okay. So I'm going to look at a couple of questions just to see what people are saying. Okay. So how do you research and decide a particular stock is a good investment? What would you say to this, Laurie?
There are a couple of key features that you would want to do in order to look at a stock more closely. Generally, a site like Yahoo Finance or Morningstar, you can pull up information on individual companies. And generally, when you do that, they're going to show you a chart of the history of the price movement on that stock. So that's, one thing that you can look at. The next item is you want to look at what's called the price earnings ratio. It's called the PE. And what that is, it's the price of the stock, the current market price, divided by the yearly earnings that the company had made. And based on what that number is and the type of stock you're investing in, when I say that, I mean, if you're investing in a very safe utility company versus a more aggressive or growth-oriented stock like Amazon, that price earning ratio is going to be incredibly different. Yeah. So that's one thing that you'll want to look at when you're looking at this at a stock. And go ahead.
Oh, go ahead. No, I'm going to jump in here too, because this is one of the main things that I do look at is price earnings ratio. And I like that accounting background, of course, so you don't have to have an accounting background. This is literally a formula. It's going to show up on your Yahoo Finance. So, and like Laurie said, right, it is going to be highly dependent on the type of industry that you're in. So if you're like looking at biopharma stocks, right, they might have a negative price to earnings ratio. They might not actually be making any money, but it's relative value. And so I think that that's the thing with stocks, is that you have to understand where their price is with comparison to their actual earnings to understand the value of what you're buying, right? So I think people are like, oh, I think this stock's going to do really well, and so I'm going to buy it. You'll have to, sometimes some of that's already priced in. If a lot of people think it's going to do really well, right, then the price might be already way above what it's currently worth. And so you think you're buying into future growth, but what you're really buying into is future risk if it doesn't pan out. So there are some things like that. If you go down the route, but like Laurie said, you don't have to buy individual stocks. And in fact, when you start, you probably should not. And even when you've been doing it for a while, unless you have some money that you kind of want to play around with. But yeah, the PE ratio is basically looking at what is the stock, doing in the marketplace and what's it actually worth. And you want a lower, right? You want a lower price to earnings ratio. Lower is good. Outside of negative. Negative is a different story, but generally a lower price to earnings ratio is good. That means it could be an undervalued stock. But generally, I just want to interject on that one.
No, that's fine. I was going to say, because right now, just to give you an idea, if you do go in and look for a price earnings ratio, the average in the market right now is probably around a 28 is what you're looking at when you take the price and divide it by the earnings. That's kind of a typical, what we call S&P stock, that stands for Standard & Poor's. So that's what you would want to check out there. So I hope that's helpful.
Yeah.
May I make one other point? Just
Yes, go.
There are so many things. There are so many things that are coming into my mind as we have this conversation. So if I get all wiggy out here, don't mind me. I just mentioned something, the S&P 500. I think it's really important for people to know that when you turn on the news at night and they tell you about what the market's done today, what they're referring to is what's called the Dow Jones. If they tell you the Dow Jones is up, down, whatever today, the Dow Jones Industrial Average is based on, it's 30 stocks. It's 30 high, what we call capitalization, meaning they're really big companies when it comes down to how much they're worth. Yeah. But that number you're seeing on the screen is based on 30 stocks. Now think about that. When we talk about diversification, 30 stocks versus one of the more widely used averages or indexes is the S&P 500. The Standard & Poor's 500, which is 500 stocks. So if you're getting a report either from your financial advisor or you're trying to figure out how your investments are performing, you always want to make sure that they're being compared apples to apples. Because if you're trying to compare the Dow Jones Industrial Average, those stocks with what a treasury bond is doing, I mean, those are two completely different avenues. And, I have had people come to me and say, well, my neighbor told me that, they got 9% return and mine only got 3%. And, you dig deeper and start to see, well, okay, they had more stock in their portfolio. You have more bonds, which don't perform the same way. So
yeah, they're less risky, but they generally are going to carry a lower interest rate, especially right now because interest rates are really low.
Always compare apples to apples. So
exactly. You want to compare 100%. You want to compare apples to apples when you're doing this. And it is important when we're talking about the market. Like the market itself is actually it's huge. Like the market is the actual market, right? But it is funny that when most of the time we talk about the market, we're talking about 30 companies. That's what they're pegging against, So that's interesting. I'm just going to go back to this one real quick because we did mention this, right? With why Amazon type company would have a different PE and what range of PE. Again, it's gonna depend on that growth versus value stock type of thing. Oftentimes with growth stocks, you're betting on the future. right? So already they're like, okay, Amazon's growing really quickly. So they're pricing in and they're going to have a higher PE ratio because people are pricing in their future, right? I used to do, this is embarrassing and you're going to hate me for it, Laurie, but I used to do a lot of biopharma. Like that was kind of the fun thing to do. And I would literally sit and listen to FDA meetings to see like, is this drug going to get approved? Because it's going to like go skyrocket. But those would have like basically negative PE ratios because they weren't actually making any money. So a lot of these speculative stocks, Facebook, when they first came on the scene, they did not make any money. The entire valuation was based on what's going to happen later, right? It wasn't based on what's going on today. And so depending on the type of stock, it's right. It's like, what are we betting on here, right? Is it like, okay, this is a well-performing stock that's going to, be steady. And therefore you're looking at that, lower PE ratios, or is this a stock that we're expecting high growth from? And you're usually going to see a higher PE ratio for those. Is that how you would kind of describe it, Laurie?
Yeah, most definitely. There's another jargon or lingo that will teach you today, or you can take this away and be sophisticated, but it's what's called the FANG stocks. Mm-hmm. That's where Amazon falls under that. You'll hear the acronym FANG, which stands for Facebook, Amazon, Netflix, and Google, which now is actually called Alphabet. But those stocks are always going to have a higher PE ratio because of the fact people believe that they're going to grow at a much more rapid pace in the future versus, again, like a utility company or even a company like Coca-Cola or Pepsi. Yeah, and they pay a dividend. I know we haven't gone there, but
Laurie. I worked for Coke for 10 years. We can't say Pepsi on this platform.
Oh no.
I'm just kidding. Anyway, but yeah, continue. Sorry.
No, that's fine. Because companies that will pay a dividend traditionally too are going to have this lower PE ratio because you're getting a payment, a piece of the profit of the company. Whereas companies like Amazon, Facebook, Netflix, those type of companies, they're taking any money and they keep plowing it back into the company. They're reinvesting it so that they can hopefully grow at a more rapid rate.
That is so true when it comes to dividends. So what a dividend really is they are returning a piece. They're using some of the cash they're generating and they're giving you money. They're like, okay, we're going to do a 12-cent a share dividend, right? Every quarter. And those big box ones typically do that. And that's one of the ways. That means basically they get to buy back the stock, so that for them helps, the balance sheet and everything else for the business. And it gives you back money. But a lot of these tech stocks that are growing, they don't have that. They don't do that because they're like, no. I'm going to go buy a bunch of stuff to grow this business faster. So it's just decisions on what businesses are going to do with their cash in order to generate it. But yes, that has an impact on the PE ratio too. If I'm looking, and I'm curious, I don't know what Laurie's viewpoint is, but if I am doing individual stocks, again, don't just buy like one, right? Like I'm putting my whole life savings in one stock. Figure out what you're okay with, with putting into a stock. But if I'm looking at like a more steady type, not your Amazons, those types of things. I love if I can find like a good PE ratio under 10. Like that is like, I'm like, ooh, that, it's a stock I like. I think they're going to grow and they've got a PE ratio of 7. And I'm like, ooh, okay. All right. So their price is 7 times earnings, basically. It's not too bad. So that's my general rule of thumb. I don't know. Laurie may totally disagree, but to your point, right? Normal is like 28. So under 10 is pretty dang good.
Yes, it's definitely, it's really good. And why, if the more you get into this, the more that you would then begin to, okay, well, I'm going to have a portion of my portfolio that are these 10 and under PEs. And then, a portion of my portfolio be a little more risky into some of these higher PE stocks.
Exactly. It's all the risk reward. I like this question just because we're talking about dividends. What do you do with dividends, Laurie? Do you take them out? Do you reinvest them?
Great question. Again, a lot of times age comes into the picture for this. If you're younger, I would suggest plowing those back in, having your dividends always reinvest. Again, that's almost its own dollar cost averaging type plan, because when you get a dividend payment, what it's going to do is just buy more shares with what the value of the dividend is. Now, if you're older and you are relying on your assets, your investment assets to provide an income for you, say when you're retired or you're at a different phase in life, many people will take the dividend payments and use those payments to supplement their income. Which, again, it brings us to another point. We're going back to bonds and interest rates. Part of the market increase, remember, interest rates right now are so low that investors, you're not able to get a 7 or 10% CD like your parents were. So what's happening is, because we have a society where so many people haven't saved for the future and are figuring out that their Social Security payment really shouldn't have been their only plan for retirement, they're finding that they have to find other alternatives to supplement income, which is forcing them to move out of the more conservative bond investments and buy stocks so that they can get a dividend. Because dividends many times can range anywhere from a percent, even to 5% sometimes on some good quality stocks. So you'll see supply demand, more money going into the market, pushing the market up, because people are looking for those quality stocks to pay them a supplemental income.
Yeah. And I think it's interesting too when we talk about interest rates, because we are in a period, still a long period of exceptionally low interest rates. So you mentioned, yes, our parents used to be able to get 7% off of a CD or something like that, right? But they also had mortgage rates of 15%, right? So what happens in those instances is often, and again, we want to diversify. Diversification is important, right? But when you're looking at stocks, bonds, real estate, let's throw real estate in here too. When does it make sense for each of these things? Well, to me, I'm going to more weight my investments when interest rates are low, right, Laurie, in stocks, probably, right? Again, depending on age and all that too, but stocks, less so bonds. I got some, but less so, because those are fixed interest. They're low interest. I'm not really making a whole heck of a lot. And maybe even real estate, because getting a mortgage cheaper right now than it than it normally would be, or I don't even know what normally is anymore, but than it has been. And so sometimes that's how interest rates really play into it. And that's part of why interest rates being as low as they are around here. I don't know about you guys, our housing market is going bananas, right? You cannot buy a house here. They're gone in a day. Inventory's low. That's part of it too. But interest rates being low, it's not a terrible time to buy real estate, outside of the fact that prices are high. So it's kind of this, you got to kind of make your decisions. And so, but as interest rates rise, that's when you're like, is the risk of the market worth it? Or do I come and buy more bonds and CDs and things like that have a steady interest rate? So that's kind of how, and we won't get into inflation, because that plays in here too, right, Laurie? I mean, there's a whole lot to unpack. Maybe we'll have you back for a second.
That's a whole nother topic.
Because then we're 43 minutes in, and I feel like we're scratching the surface on all of this. So I'm going to ask you from somebody, because I think it's a really good, if you're just starting out, question. Can you buy just one stock? Right? You can. Yeah. I don't know that, again, can. And that can be a place to start. I'm just going to buy one stock and see how it goes. But again, I think as you start investing, probably best to go with something a little bit more diversified, especially if you're putting, if you just want to put a little bit of play money in, that's one thing. But when you really kind of get an investment strategy, usually it's going to be something that's a little bit more diversified through mutual funds or exchange traded funds, those types of things. But where would you suggest that people go? If they're like, I don't know where to start, where do I set up an account?
Really important to think about fees. First of all, when you start, just even start with investments. One stock I hear, she might run into a problem and with fees. So there are
Sure.
online platforms that allow you to purchase, just one share of stock. Robinhood has become a very popular name recently.
Slightly controversial these days, but yes.
Yes, something along those lines. I personally prefer. I do most. I don't get paid. I do most of my trading through TD Ameritrade. I like their platform. There is no cost for purchasing stocks. I like that a lot, and I've always had a good experience. But you have other platforms like Charles Schwab, and
Right.
Fidelity. Those are other places that you can go in and actually purchase stock.
And some are going to have, some accounts. It depends too. Do you want one that has somebody that you can reach out to, an actual like broker that you can talk to about things? That's going to be more probably, right? Or like a lot of them now are just these platforms. The market has become so much more accessible just in the last like 20 years. I mean, the accessibility of the market to go on and just be like, I'm going to set up a trading account. You can probably get one set up in 5 minutes, right? The fees are lower. When I first started trading, I mean, this was 17. I mean, I was like, if I had to buy and sell a stock, it was like $100. Like, it costs a lot of money. And so I'm like, well, I'm not going to do that. Now it's like, there's free, or like $6 a trade, I mean, there's all kinds of things. It's so much more accessible to the average person, which I think is a really good thing, right? But we have to educate ourselves because otherwise
I was going to
you
say
get
yes.
taken advantage of, right? You
With
can get
that,
taken advantage of in the marketplace by the big guys who know what they're doing. If you have no idea and you're trying to buy individual stocks and trade them and do like highs and lows and, I mean, it is interesting though. I mean, Laurie and I had mentioned earlier, and again, we won't get into too many thoughts on this, but like the GameStop thing, I think everybody was like, whoa, what happened there, right? Where in the short term, crazy things can happen with stocks. In the short term, I mean, it can get nuts. Over the long term, generally though, your valuation is what matters, right? The actual value of the company, what they are actually like, their actual earnings matter. Like all of those things are going to play into the price of a stock. But a stock can absolutely be way overpriced and way underpriced at any given time, especially when the market is more volatile. So that gives opportunity too in some instances.
absolutely.
Yeah, I mean, I think there are a lot of different platforms. Just to Laurie's point, look at fees, understand, go compare them. Look at whether they have like holding. I mean, some of them have very weird rules around taking your money out, putting it in, minimums, right? Is there a minimum you have to have? Some of them you get better rates and things like that when you have a certain amount of money. But it is so much more accessible. And that's what makes it great, is that there are so many different platforms and ways that you can get involved and apps that you can just put on your phone and start investing, right? But educate. I
was going to say with that, the freedom and the accessibility comes, again, the responsibility of, unfortunately on us to educate ourselves about it. But I know your audience is very diverse, like in terms of like age. Can I also just say, please talk about these things in your household. Talk about this kind of stuff with your kids. Don't make it taboo. Let them see that, oh, well, hey, mom and dad are having a talk about it, investing, and make it normal, natural to talk about it. And
so
let's break that cycle.
It's so funny that you say that. I have a book that I go over with my son. He's 7. And you'd think it'd be too early, but it's all about different things you can do with your money. And it's about, okay, we can spend our money, right? We can save our money. Okay. We can invest our money, and we can give our money. And so it's kind of teaching those lessons at this very young age of like, okay, how do we be a good steward of our money and what we are given and put it in the places that it's going to, be best off. And so when I had this conversation, and I've had it with my son about, okay, he just got money for my birthday and he's like, I want to go buy a Nintendo game. And so we sit down, we're like, okay, let's talk about, and in this book, it talks about investing. And I was trying to explain compound interest and just how it works, where you invest money and it turns into more money. And I was like, so, if you take this $60 that you want to go buy a game with and you put it into, let's say the market, and you get, I don't know, 7% interest, something like that, right? 7 to 10 years. I don't know. I can't do the math in my head. But you would have basically $120. And he's like, what? And I was like, yeah, if you just
that caught his ear.
It'll double eventually, let's call it 7-8 years if you're doing pretty well. And he's like, huh? Like it just doubles. And I'm like, yeah, kind of. I mean, it's not guaranteed, but that's the sort of the power of compound interest. And then I'm like, and then if you leave it another, and then I'm like, now it's 240. And he's like, what? Like it blew his
That's
mind.
crazy.
And all of a sudden he's like, I'm gonna invest this. And I'm like, well, that's gonna be a little tough. So I'll tell you, I'm gonna try to figure out how to buy a $60 stock for my son.
Okay. There you go. It's a great experience. And, I think too, when you just brought that up about interest, can we talk just real quick, a quick formula? When you talk about money doubling, it's called the rule of 72, that if you take the number 72 and divide it by the growth rate or the interest rate you're getting on an investment, that'll give you the number of years it'll take your investment to double. Yeah. So for example, if let's just say you have, you're getting an average of 8% on some kind of investment. If you take 72 divided by 8, it's going to take 9 years for your money to double. Yeah. Now take that with a 1% savings account or CD. Take 72 divided by 1. It's going to take you 72 years for that just to double in a number. We won't go down the whole inflation road with that, but it's worth less. So that's kind of powerful.
Yeah. And that's a good formula to know. And that's something that Myrnie, I'm going to put Myrnie up here too, because she talks about this a lot with the rule of 72. I did a little virtual event with her, and this was one of the big things that they talked about. But it is important for me, I read a book. It was actually Smart Women Finish Rich, David Bach. Mm-hmm. I read it when I was 17. It had just come out. And I read it and I saw the chart of compound interest, kind of like my son. And I was like, so if I put $100 a month, that's going to turn into like $1 million of it. Like it blew my mind when you actually look at the dollars and cents of it all. And I immediately was like, okay, so now when I'm making decisions in where I spend my money, now that's going through my little 17-year-old head is like, do I want this outfit or and so that part of it made me into like like I said, like I'm just going to keep it all and just let it grow and see what happens. But I think that's a really good lesson to learn. And the younger that you learn it, and not to say like if you're watching this and you're on the older side, there's still a lot of benefit you can get from investing your money, even if you haven't started yet. But the younger that you start, right? And this is something for those of us that have kids, the younger that our kids understand this and know about this. So as you're learning about it, like making sure that our kids are understanding the power that money has, right? How money can work for you. It's going to set them up for success, right? If you're like, I wish somebody had told me, well, like now you can learn this together. And there are books and there are things like that, not to go on an aside, but this is something like we talk about it a lot in this household, and not in a like money doesn't grow on trees kind of way, because that's annoying. That was what I always got, And so that led like to the scarcity mindset thing that I still deal with and have to combat. But we want to raise our kids with a healthy awareness of the different options, and that money is not good or evil, right? We all probably have a feeling that like, it's bad to want money. Maybe that's a very common mindset issue that we have around just like, money is the root of all evil, right? But here's the thing, truthfully, money is a tool. And it is what you do with that money. Money can also do extremely good things in this world. And we know that, right? So it's not bad or good, but it gives you options, right? And money is not the end all be all, but it gives you options. And when you aren't worried about it all the time, you can live into the life that you are meant to have more, right? The person that you're meant to be and not be consumed with the worry about it. So sorry, that was my little diatribe.
I love, nope, we're on the complete same page
Laurie,
there.
Laurie and I are just going to get off of this and we're going to talk for another 3 hours. So Laurie, tell people about what does it look like to work with you, which I am currently doing right now, but what does it look like to work with you in, what you offer? And then I think you have a free gift for our audience.
I do.
So
Yes.
y'all who have stuck around, you get and I'll post it in the group too. So tell us a little bit about both of those things.
Yes. Well, what I do is that I help people put together a plan so that no matter where they are in the stage, whether they're younger, whether they're older, I help them with a plan, as we talked about at the very beginning. Talk about and identify those things that are really important to you, because if you don't take the time to do it, to research or just kind of set your mind free and think about it, I help fill in those gaps from where you are now to where you want to be. We put a plan in place, look at where you're saving now, where you could be saving more, what you can perhaps. So I help put those sorts of plans together for people.
Yeah, I love that. And it's a literal written plan, you guys, right? So it's you get a whole thing that's okay, given your specific dreams and the things that you want to achieve, here's how you do that, right? It's like a roadmap. Y'all know I love a roadmap. I love a roadmap because we can all be I would love this someday, right? Laurie and I have talked about one of my big goals. I would love to have a vacation home. I have no idea. I'm I don't know if it's achievable or not. Let's sit down and figure it out, right? And so when we continue with this someday without creating the plan for it, for me, we've had this rolling 5-year, in 5 years. Well, that was 3 years ago. We said in 5 years. And until we actually sit down and we are mapping it out and know that we can do it and still be in good footing, right? We're that is going to give so much confidence to actually make progress towards those goals. Because otherwise, we just,
and you hit those little milestones, and it really helps you, when you can identify and see, wow, we hit the first thing that we wanted to achieve. Yeah. My gosh, then you really start to become, more into it. And then your kids see you get really excited about talking about it and goals. So
bringing them in.
So that's what I do. That's what I do.
So free gift. Tell
free
us about
gift. It. Yes. What I did, it is never too late. I put together what I call the Successful Women Investor Guide. It's more or less like a checklist for you to go through and, just look at some of the things that are, there's 10 things that I think are really important that I put together over, my 30 years of working with people and what they found to be the most important things as they move forward. So it's located it's on my website. You'll only find it if you're here because it's www.herwealthcoach.com/Jamie.
Jamie. All right. I'm posting it in the chat for you guys and I'll put it up here. So this is where you're going to want to go, right? That's right.
Yes, that's correct.
Mm-hmm. Definitely go check that out. Totally free, you guys. Laurie put this together just for us, which is so sweet. So herwealthcoach.com/Jamie. It's in the chat too. I'll post it in the group so that you guys can grab that. And let me look through comments real quick. Yes, right? She's so great. She's so great. That's why she's a preferred vendor. And that's why I was we got to come and talk about this. And we went an hour. I was Laurie was how long do you like this to be? I'm I don't know, 30 minutes. We usually go a little over. It's been an hour, but I think hopefully it's been useful. Again, like I said, I think we need to do this again because I just feel there's so much. There's so much to unpack in all of this.
Let's learn together.
Let's learn it all together, you guys.
Can I also just a shameless plug? I also have a Facebook group that I talk about personal finance and investing. It's called Wealthy Talk for Women.
Wealthy Talk for Women. Mm-hmm. Got it. All right, guys. And Autumn will probably drop that in here too. Awesome, awesome, awesome. Well, Laurie, thank you, thank you, thank you for joining us. This
Oh,
was
thank
great. I
you.
hope you feel empowered. I hope like some of y'all are jumping off of here and thinking about, okay, how can I like just get started today, right? How can I, whatever it is, whether it's, reading a book, talking to Laurie, like making an appointment with Laurie, setting up a brokerage account. I would love for you guys to do something with it today and then let us know. Come back to these comments and tell us like what action you took as a result of this, because I just think it's small actions that can make a really big difference. So anyway, thank you guys. You guys are
Thank
awesome.
you.
Yeah, we need a segment with Laurie. All right. And here it is, Wealthy Talk for Women. Go join the Facebook group and grab her freebie. All right. Bye, guys.
Thanks, Jamie. Bye, everybody.